Here is part 4 of our Chapter 4 video lecture series, where we continue with the second half of Chapter 4 dealing with deductions for AGI. Let me illustrate this term here. So we've already learned in past chapters income that is taxable, or here in Chapter 4, or really the previous chapter, income that's includable. And then now here in chapter 4, the second half, we're going to subtract out deductions called adjustments to get to that term we've seen, adjusted gross income. And then we subtract out the standard deduction, a topic way back in chapter 1. Or an option would be to deduct itemized deductions that we're going to learn in our next chapter, chapter 5, to get to the base called taxable income that we would look up on the tax table or tax rate schedule to get the tax liability for the year. And then, of course, we subtract out credits that we have covered back in chapter 2 and prepayments to get the overall overpayment, maybe refunded or amount due. Okay, so now we're focusing on right here, these adjustments. So sometimes we say these are deductions for getting to AGI versus deductions from, subtracted from AGI, like the standard deduction or itemized deductions. Also, this line here is called the line. So deductions can be above the line, which are better than usually deductions below the line. Sometimes you may have a choice. Most times not. It's going to be either above or below, but sometimes you have a choice. And if you do, then above the line deductions, the for AGI deductions are better usually than from AGI. So we're going to learn more next semester when we deal with people that have their own business, and we're going to prepare a form called a Schedule C. And on that Schedule C, we report business income, and we're going to minus out business deductions. So all of that is going to be included in here, this income. So any business deductions are already above the line or for AGI. The same thing would apply with landlords who have rental income, and they're going to subtract out the rental deductions on a form we'll see next semester called Schedule E. Again, a landlord's deductions will already be subtracted to get to probably this income number up here. So it's above or for AGI deductions. The middle topic, losses if you sell property, or even gains when you sell property. We'll see that at the end of this semester when we prepare a Schedule D. Okay, so we'll find out we can reduce our taxes with these losses. Most of the 4 AGI deductions are listed here, and we cover in the second half of chapter 4. But probably a better place to look at these deductions is on the tax form. So let's take a look at the 1040 form. We've already seen, of course, income items listed here. And here's a topic again we'll cover in our last couple chapters of the semester. Other income we saw back again in chapter 3. And now we're talking about this here, adjustments or deductions for AGI. That's reported on Schedule number 1, then subtracted to get to the adjusted gross income number. Let's take a look at Schedule number 1. We've seen this form. Remember, we had this additional income items back in chapter 3. Now here in chapter 4, we're going to look at the deductions, the adjustments. So the first one mentioned here is if you're a teacher from grades K to 12th grade and you incur costs for your classroom like supplies or even professional development costs for you to learn your curriculum or teacher training. Up to $250 for the year can be deducted for that teacher. And if you have a married couple who are both teachers, you can double this amount, $250 each. Okay, it's not automatic. You gotta have proof, yeah, receipts of this type of costs. The line 11 here, the cost for being an employee as a reservist, military or naval or air force, you're a performing artist, or if you're a government official that you get paid on a fee basis, you may be able to deduct employment costs related to these jobs, but most times it's not going to be any. In the case of reservists, basically you're looking at transportation costs to get to your reserve training. If you get reimbursed, then there's nothing to deduct. In the case of performing artists, it's literally the proverbial starving, in this case, performing artists, because you have to have, I think, less than 16,000 of taxable income for the year. Otherwise, if you have more than that, you cannot deduct any business costs. And for most government officials, yeah, maybe even if you're fee-based, they probably will reimburse you for your costs, typically again for travel. So I think I've seen this type of deduction only a couple times in my life. If you were not these positions but were incurring as an employee business expenses, that deduction was eliminated back in 2018. Was once a itemized deduction, but no longer. In fact, I think if you take a look at our chapter 6, it dealt basically with that deduction, and now in our current book, it's so thin, just a few pages long, because probably if you're an employee and you incur business expenses for your job, you probably cannot deduct them. Health savings account, I think we talked about this as a deduction back in the previous video. And again, it's not a common deduction in Hawaii because you're required to also have at the same time a high deductible insurance policy, a high deductible insurance plan. And again, most people in Hawaii don't have that. But if you do qualify for it, if you can take a deduction, it's a good benefit because now when you take out money, you can pay off your deductible costs, your co-payments. And if you're covered with Medicare, you're making Medicare insurance premium payments, you can also use the money in this account to make those payments. Okay, so not common, so I'm not going to go into any more detail here. Moving expenses, if it's employment related, one time back in 2018, prior to 2018, it was deductible, but no longer unless you're in the armed forces. And for most times, the government is going to pay for your moving expenses up, I guess, to a certain limit. This would be any cost in addition to that. So we're not going to cover that, yeah? For those of you in the military, you can probably get tax help on base, yeah, with some type of office that provides free tax preparation. If you take a look at lines 14, 15, and 16, there's a term here, self-employment. See, yeah, self-employed, self-employed. So all of these deal with people that have their own business, not employees now, but you are self-employed, owning your own business. So again, that's going to be reported on a Schedule C that we'll see next semester, probably in Chapter 7, our first chapter for next semester's Accounting 137 class. Here's a penalty, meaning that you had to take money out early from your what they call certificate of deposit. Let's take a look at the form that we should be familiar with already, and that's the 1099 form, INT, that reports interest income here in box number 1. So that could be a savings account, maybe even checking account. Of course, the interest rates are so low, you're not going to probably get too much for this and coming years. But if you were investing in something called a certificate of deposit, that means you have to leave your money with the bank or financial institution for a set period of time. Could be a few months, could be a year or many years. But if you cash in your certificate early, You still have to report all of this interest on your tax return and pay taxes on it. But the bank, not the government, the bank will penalize you for cashing in that certificate of deposit early. And whatever dollar amount is listed here, you can claim as a deduction here on your schedule number 1, here in line 17, penalty for early withdrawal. We've talked about alimony in the previous chapter. So if you're paying alimony, maybe you can get a deduction. But if you're receiving alimony, here you have to report it as income. And that's the rule if you got a divorce decree or a legal separation prior to 2019. But now, if your divorce occurred after 2018, it's no longer deductible when you make alimony payments. It's no longer taxable when you receive alimony payments. The next line here as an adjustment is IRAs. So that's going to be our next video, both traditional and Roth IRAs. Next deduction, if you're a student, maybe you had borrowed money to go to school to help you pay for qualifying costs. Again, that's basically tuition, textbooks, supplies, even room and board. And if you're at least half-time student, maybe now when you start paying off your student loans, you get to deduct interest. The interest is reported to the student or maybe even the parents who had signed off on the loan here on a form called 1098E. And here is the interest that was paid during the year. Again, probably the student has already graduated. Probably the borrower could either be the student, assuming the student now is no longer a dependent, or could be the parent. If you have a choice, it may be possible to pick the person that can better benefit from the loan that's actually making the payments here. But there are limits to the amount you can deduct. The limitation is not on any tax form, but it's on a worksheet in the instructions to the 1040 form here on page 90. This student loan interest deduction worksheet. So the maximum amount you can deduct of interest now, not the principal repayment, but interest on that form 1098E is $2,500 for the year. And what you're trying to figure out in some of these lines is the adjusted gross income before deducting any student loan interest. And if you're, let's see, if you're single or married, you have different income limitations. Here, if you are single and you make more than 70,000, let's see, 70,000. I think you cannot deduct anything. Let's figure this out here. AGI minus this limit, and we got an excess if we're less than, if you're less than 70,000 as single, that means you can deduct all of the interest you put up here. If it's a married filing joint return, and you gotta file joint if you're married. If you make less than 140, whatever interest you have up here will all be deductible. Now, if your AGI exceeds 70 and exceeds 140,000, then maybe the interest in line 1 will start to phase out. In the case of single, here you can see 15,000. So that means if you go up to another 85,000, if you're single and your AGI is over 85, none of the interest is deductible. Here is 30. So that means if you're married filing joint and your AGI goes over 170, none of the interest is deductible. Okay, so if you work through this worksheet, here at the bottom is the amount that will be deductible. And you report it back on the schedule number 1 here in line 20. This last deduction is something that was brought back last minute. So our textbook doesn't even mention it, I believe. This is called a tuition and fee deduction. And it's calculated on this form here. So before we take a look at the form, let me illustrate first about the different ways of claiming education costs. We call that qualified education costs. Not everything is deductible. Basically, again, we're always looking at tuition. Most times textbooks, uh, sometimes supplies, sometimes, well, maybe never in this case for room and board. Then we reduce that cost by any tax-free scholarship you receive or grants to get the remaining costs that now we can claim either for the credit that we learned back in chapter 2. If you remember, we have the American Opportunities Tax Credit, and the other education credit was called the Lifetime Learning Credit. Or here, another option is to claim that cost as a tuition and fee deduction, a 4 AGI deduction. Typically, the best option here is the American Opportunities Credit. And if you don't qualify for the American Opportunities Credit, then you may need to calculate both the lifetime learning and the tuition and fee deduction to determine which is better. We'll see next semester if this type of cost is eligible to be claimed as a business expense for your own business. This may be either the first or second choice of these 4 now, yeah, but we're just learning these 3. Again, American Opportunities, depending upon if you claim the full credit, is probably the way to go. And then if your cost doesn't qualify, then one of these 2. Let's take a look at the form that calculates the tuition and fee deduction. Here's our form 8917, again to calculate the tuition and fee deduction, where we would list down the student's name, could be the taxpayer, could be the spouse, could be dependents, and the amount of qualifying costs, and the total cost for the year. Again, if you've used this cost to claim education credits, you cannot claim it again. If you use this cost to offset tax-free scholarship, you cannot get a double benefit by taking the deduction. So what we're calculating here is the taxpayer's adjusted gross income before deducting this tuition and fee deduction. And if your AGI, if your married filing joint, exceeds $160,000, there is no deduction. Your deduction gets phased out because you have too much income. For other filing statuses, if your AGI is above 80,000, there is no deduction. Okay. Now, if your AGI is under these amounts here, then you get a $4,000 maximum deduction. Yeah, you're comparing it with the cost over here. Yeah. But the maximum deduction will be 4,000 if your AGI is 65 or 130,000 depending upon your filing status. Now, if your AGI goes above 80 and 60, then again you get nothing. Now, if your AGI falls within these 2 ranges here, then you get a 2,000 max deduction. You notice how it doesn't gradually phase out. It's just like a step. You get this big amount, then this smaller amount, then 0. Yeah. So whatever amount you see here, that's what you claim back on the schedule number 1 here in the last line. So you total up all of your adjustments and then you rewrite it back here on the 1040 form in line 8b that you subtract out to get the AGI. Okay, so let's stop here and continue with the last video that we talk about individual retirement accounts.